Hey friends, it's time for another Charts of the Week. Only our format's changed. Now we're going to start doing Charts of the Week in a video format. Gives me a little bit of opportunity to talk more about what I'm seeing, why it's interesting to me. I hope you like this new format. If you have any questions or feedback, feel free to leave them in the comments below. First on screen, Nvidia up over 17,000% over the last decade plus. A lot of that move happening recently since 2020. And this is an incredible story with this company. I was a little hesitant to buy into what all was happening at Nvidia in late 2022, but as time went on, my view evolved. And I think this company is actually leading a lot of really important charges in terms of what's happening with AI. They've really developed a hardware ecology and software development model with CUDA that is very hard for competition to encroach upon. Now, that doesn't mean that I think that Nvidia can't pull back. I do think that we run a lot of risk going into the next earnings on the 21st of Feb, that if they don't meet or exceed investor expectations, you could see a pullback here. You also have skew blown out towards calls, so a lot more concern about missing upside than hedging downside, which can sometimes make it more difficult for rallies to continue. Nevertheless, I heard so many rumors about this company being a fraud, a Ponzi scheme. A lot of that came down to a misunderstanding of financial accounting or just digging really, really deep, trying to connect dots. And while I commend the efforts of folks that were looking into this stuff, there were some interesting things out there. The overall overarching theme that this company is somehow engaged in malfeasance just doesn't add up to me. I'm sorry. I don't see it. One of the biggest criticisms that I would hear is, how are their margins so big? How is it that Taiwan Semi is not seeing the same kind of revenue growth that Nvidia is? I've got that in one slide for you. It costs Nvidia about $3,300 to make one of their H100s. These are like the most sought after AI accelerator chips, circuits that you can get out there. It's really like a board, right? It's not just a single chip. And the average sale price of these is $30,000. So you can already see their margins are insane. This is why you don't see TSM having the same revenue, because Nvidia is like 9xing it, right? So you're not going to see their suppliers have the same growth. Now, there's also a huge secondary market for these. You find them on eBay for 45 grand, even on CDW for as much as 97 grand. So what does that tell you? It tells you demand is still robust. Now, eventually, things will change. Nvidia does have more competition coming online, and eventually the software ecology to develop for those competing processor types will become more robust. So I don't think that this is a never-ending story, but I think it's a very interesting story. Nvidia is one of the sellers of picks and shovels in the AI rush. If you remember studying the gold rush from way back in the 1800s, 1900s, there were sellers of picks and shovels. They were the ones that made a lot of money. It wasn't necessarily the prospectors, right, who are looking for gold. This is the same kind of story, and this is why it's so interesting to me. You don't necessarily see a lot of the AI companies showing that same growth. There are exceptions. Obviously, Microsoft and Palantir and Silicon Micro, or Supermicro, my apologies, are pick and shovel sellers as well. But you go downstream and you don't necessarily see that translation to the bottom line with increased margins and productivity happening across a wide swath of industries, at least yet. That's the part that I need to see to really say this is more than just hype. Now, I believe there's a lot that will come out of AI. Don't get me wrong. What I've said from the very beginning is I think a lot of future returns are being pulled into the present. I do believe AI has a lot of potential to change how we do business, to increase productivity, to help us manage really large sets of data and understand more about them. I just think that we've gotten a little bit excited in some of the things that have been happening, in various more speculative areas of the market that pertain to AI. So let's keep the conversation going. I want to talk about something a little bit different. Over across the pond, Europe's equivalent of the Magnificent Seven has kept pace. It's called the granolas, if you will: GlaxoSmithKline, Roche, ASML, Nestle, Novartis, Novo Nordisk, L'Oreal, LVMH, AstraZeneca, SAP, and Sanofi. These have kept pace with the Mag 7, although the Mag 7 had a much bigger drawdown. It's pretty incredible to see that there's another cadre of really large companies that are returning so much value to shareholders. So this is something to take into consideration as well, that this sort of chasing the largest companies idea is not unique to the United States. It is happening across the pond in Europe, and that is an area of concentrated outperformance as well. Going back to the United States, US's IT sector market cap has risen above 1/3 of the total market capitalization of the US. And as someone pointed out in the replies when I tweeted this, if you were to factor in all of the areas of the S&P that are no longer considered tech, but are tech, this would be closer to 50, maybe 55%, possibly higher. It's incredible. And look, on the one hand, this is not like the dot-com bubble, okay? These are not just like companies who put tech in their name and then all of a sudden their stock is going up. Like in the dot-com bubble, anything could just put .com at the end of the name of the company, and all of a sudden it was like a new internet stock, and it would just rise based on multiple expansion if it made money at all. This is a bit different. It's a bit different in several ways. There is real growth happening now. Technology is really seeing a lot of improvement in terms of its fundamentals. But that being said, we are in a multiple expansion-driven rally from 2023 on. And a lot of that multiple expansion is even underestimated based on the amount of buybacks that are happening that are helping to juice valuations to make them seem like they're better than they really are. So I would say it's a mixed picture. There is definitely a huge change happening in the world of technology. It's just a question as to how much of these returns that are being pulled forward into the present are justified versus how much that have been pulled forward into the present may need to be re-rated. So let's look at that excitement level, because I've never seen anything like this before in my life. I've been trading these markets for 19 years. U.S. equity futures positioning from asset managers is the highest it's ever been. Granted, this is in billions, right? We're not talking about contracts. So maybe if you do some magic and adjust for inflation, you might come to some different conclusions around here. But I think it's still going to be about the highest, even in real terms. Why is this important? Because you start to ask how many more folks are left to buy, particularly at these lofty levels. And then also on the other side of it, one has to ask if there is a materially adverse event for any of the Magnificent Five, where most of these returns are coming from, how does that impact risk appetites and price discovery when you may have a lot of motivated sellers coming online who had been buying, at or near these all-time highs based on what we're seeing on this chart here? And hedge funds are very leveraged. Now, we're talking about gross leverage. I know a lot of folks look at net leverage, and it's important to look at that too. They're not super long here. So let me clarify. They're very leveraged, meaning they're very short and very long. Okay, so they have two sides of their book that they trade to kind of try to balance out their exposure. Gross leverage is close to 270%. That may be the highest it's ever been. That's the highest I recall it being. Now, why does that matter? Because the idea of being balanced in one's portfolio it's a bit of a misnomer. When we look at net leverage, it's not telling us that whole story just below 70. Because what hedge funds tend to do, and these are, look, if you're listening out there and you work at a hedge fund, I'm not trying to disparage you. You guys are very talented, very smart folks, but you get a little excited sometimes and crowd into the same trades, which can leave some level of imbalance, particularly when the market works against those trades. For example, some of the very best trades that we had at TraderAid were taking the other side of those crowded shorts, like in Mara or GCT or Zim or some of these others. Why? Because we saw a really crowded stock that had a small float and a catalyst to force shorts to unwind. And then we started seeing unusual activity in options that further boosted our confidence in the trade. Now, why was that happening? Because when one side of the hedge fund's book is working against them, they typically have to shrink that side of the book. So if those crowded shorts are rallying, they're likely to cover into that and add to that upside momentum. On the other side of it, if the long side of their book isn't working and they're crowded into these Mag 7 stocks, I guess we're calling them the Mag 5 now, but nevertheless, they're in the 7. And a lot of them are also in the NASDAQ futures and other similar proxies. And so when that goes against them, right, they start distributing that side of their book. So you get some exaggerated moves in the distribution of their longs, which are concentrated in big tech, and in the reaccumulation of their short exposure so that they're, flattening that out. So you see these jumps in the Russell, which is their favorite macro product to short, as they call it. It's an index ETF for the Russell 2000. And then you see it in these single stocks. So why does the gross leverage being this high matter? It matters because if you get moves that really go against one or both sides of their books, it can exaggerate market volatility. And those price discovery outcomes are something we need to be aware of as sort of a tail risk, right? It's a left tail risk in the Mag 7 and in techs. It's a right tail risk in the most shorted areas like the Russell and some of these single stocks that they're highly shorting. Look at this here. This is a ratio of the S&P equal weight versus market cap weight. Often is the case that when this ratio gets this low, unpleasant things are happening. The question is whether this time is different. I don't have the answer to that question. All I can say is this is an ominous sign because it suggests extreme concentration. A lot of these times where you see this drawdown in equal weight versus market cap weight is during an event where the market's coming down. This is actually happening a little differently. This time it's happening when the market's coming up, sort of like we saw during the dot-com era. Now, again, I'm not trying to say that these two times are the same. I've clarified earlier why I think they're different. But this is still concerning because you don't want to have the market making all-time highs with no breadth. That's generally a worrisome sign. Now, if that breadth expands, then we can all breathe a big sigh of relief. We've probably got room for this to rotate into less loved areas and continue moving higher. But if the opposite happens, and instead we see a materially adverse event to one or more of the Mag 5, that can lead to a pretty significant re-rating of risk lower. So this is another thing that kind of just adds to our, okay, we need to see what happens next. Are we going to see the equal weight start to outperform? If so, great. That probably means we're okay. If we don't, if instead we see the Mag 5 start to roll over without equal weight really coming back up, and maybe they're outperforming for less than ideal reasons, that is to say they're falling less than the Mag 5, then the market will probably roll over given how much weighting there is in these huge companies. And financial conditions are the easiest in 2 years. It's almost as if the Fed didn't do anything at all. Right? And the market's continuing to expect this dovish Fed pivot. Whether it ends up happening as soon as the market expects is a whole other matter altogether. Remember, initially the market expected cuts to begin in March. Now they're discounting whether cuts are even going to happen in May. So some of this easing in financial conditions may be a little ahead of itself. We are starting to see some signs that rates are coming back up. And I think that could put some pressure on stocks. And I actually just released a Navigating the Market, so you can check out on my YouTube, on my Twitter, and on TraderAid. This is one that I release free for everyone, but I do these every week for our premium members to try to talk about where there might be some areas to watch for opportunities for risk and what I'm seeing on my radar. That re-rating of risk could affect equities negatively, particularly if the rally doesn't broaden out. That's the long and short of it. Now, credit markets are quite sanguine here. We can see spreads have narrowed, suggesting that there really isn't much concern about the high yield credit areas in particular, right? People aren't concerned about defaults or even delinquencies in high yield. There aren't many signs to be too terribly concerned about. The biggest area of stress that I'm seeing right now are really low quality borrowers. So subprime auto loans, subprime, credit card loans, younger borrowers, no offense intended, but their delinquency rates are quite elevated, about the highest since 2010 or so. But looking at a broad aggregate, delinquency rates are very low. Like they're just normalizing to pre-pandemic levels. There's a bottom half, a sort of bottom 50% of income earners that are struggling, but the top quintile, top 25% or quartile are doing great. So you see that masking a lot of the data. And unfortunately for that bottom half, that means there's probably some more time for them to kind of have to deal with this struggle, because the Fed has said, we're done with our hiking. So there's not a lot more relief to come in terms of inflation. Will the rate come down? The rate of change for inflation? It could. It could come down. But will we see prices come down? Well, Janet Yellen told us probably not, and that's not a worry in her mind because wages are going up. Now, real wages are not going up enough to offset the last 50 plus years of cumulative inflation, but that's the mindset of policymakers. They want to keep low level inflation going. And we'll look at a cumulative inflation chart in a little while so I can show you what I'm talking about here. But nevertheless, that means that we still have this sort of K-shaped recovery. The bottom half not doing quite as well. The top 25% probably never doing better. And it's interesting because we look at this in the context of real Fed funds rates at the highest levels in 20 years. That makes fixed income much more attractive. This is one of the reasons you see savers piling into bills and money markets, and to a lesser extent notes and bonds and other fixed income products. This is also why I don't think that all the money that's winding up in the money market, as we can see on this chart, a record high of over $6 trillion. Last checked, it was about 6.2 now. There's not a lot of reason for that money to go out and chase stocks where equity risk premiums are the lowest in 20, 25 years, depending on what you're comparing against. It also means that fixed income for this huge, huge area of savers in the U.S., the boomers, who have most of the wealth in this country. If you break it down by age groups, the boomers are the most prosperous, which makes sense. They've been saving. They lived during a time where the stock market absolutely killed it, as did real estate, bonds, etc. So they're doing really well. But that also means that they're really looking more for capital preservation versus appreciation. They're looking for fixed income rather than risk, which means all this money that's sitting on the sidelines from that group, as well as corporates, is more likely to come into fixed income than equities, in my humble opinion. But speaking of equities, look at this. This is the penny stock casino. This is the volume of shares traded in the penny stock casino. We have not seen this type of volume that we're seeing recently, really, ever. If you look at the last year of penny stock trading, even 2020 and 2021, overall pale in comparison. This is just a steady ramp up, hitting this crescendo of just pure speculation. And I get it. It's a fun trading vehicle if you're good at trading penny stocks. I'm not disparaging that whatsoever. But this is also a sign that risk appetite in some of the really low quality areas of the market is quite robust. Now, we are in February. We're about to head into the second half of February. The 1 month NASDAQ returns since 1985 make February the second worst month. September, really the only month on the chart where the NASDAQ's having a drawdown during that same period. But what makes February interesting is it's really the second half of the month post OPEX. That tends to be more difficult, and we are in OPEX week now. So I believe that from Thursday on, this month could be a bit more choppy. Something to take into consideration, particularly given we've got pretty elevated skew going into this week. So it's a reasonably hedged market, and that's going to add that passive bid to the S&P that helps it, particularly during the first and last hour of trading, as dealers are taking some of those short positions off, as the puts that drive that put skew that are used as hedges to reduce value at risk, as those puts lose value, right? So you don't have to delta hedge as much quantity of short S&P futures contracts if those puts are losing value. That's a net positive effect for liquidity in the market, because as they're removing those hedges, they're net buying S&P futures. But as we get into the second half of this month, from really Thursday this week on, that stops. And we start to see a window, as Cem Carson calls it, the window of weakness, or a window of opportunity for more price discovery without that gamma clench, without those flows kind of keeping us a little bit less volatile. So a big question that I've asked, and many ask me, and we see people positing this out there on social and otherwise, is it a bubble? And if it is, where are we in the bubble? I do think overall parts of this market are a bubble, particularly the Magnificent Five, where a lot of the rally has been driven by multiple expansion outside of maybe Nvidia. So I do think that there are parts of this market that are in a bubble. I don't think it's so much the inglorious 495 or 493 or whatever it is, the number of stocks in the S&P that don't qualify as being magnificent, that have been unloved, that is not as much of a bubble in a lot of those stocks, right? Their valuations are still a bit lofty overall. But really, when you look at the outperformance and how it's been led by multiple expansion, that's where I'd be concerned about that bubble. And again, I've talked about the idea of pulling forward future returns into the present. Well, we've been doing a lot of that. We've been pulling forward a lot of future returns into the present. And that's what suggests with those companies in particular that we may be in a bit of a bubble. Now, what phase of that bubble? I would say probably more of the mania or blow off phase is what we're in right now. But time will tell. No one can predict this stuff, and I'm not going to claim that I have a window into the future. I'm just providing my own opinion based on trading these markets for, almost 2 decades. Now, the majority of declines have occurred after the Fed's pivot during difficult markets. This time may or may not be different. Why does that matter in the context of where we are right now? Making all-time highs, first, you got to ask yourself, why is the Fed going to cut with stock prices at all-time highs, housing prices near all-time highs, the labor market tight with 1.4 jobs available for every person seeking work? They're all the things that would tell them, there's no reason to cut and there's every reason to consider maybe even hiking again are out there. But there are other issues that may compel them to cut that have more to do with liquidity. Nevertheless, context is key. So if you're going to see a big drawdown, it's more likely to happen if the economy really slips. That's what we've looked at. If we're looking back at, when there have been soft landings and when there have been hard landings and what the outcome is for the stock market, that soft landing situation, which has only happened twice in the last, 60 years, leads to an okay outcome for U.S. stocks. Usually they continue to move higher after the Fed pivots and starts cutting. And that's the context of a pivot in this chart. On the other side, however, if the economy does really slip, then it's likely that when the Fed starts cutting, they're cutting in response to something problematic, and that usually leads to a re-rating of risk lower. Happy days, the U.S. is the biggest oil exporter in the world. We have reached so much oil production that we more than offset half of OPEC Plus's cuts. And that's one reason that the price of oil hasn't gotten as strong of a rebid after those cuts that perhaps some of those countries were hoping for. Moving over to the housing market, housing is as unaffordable as it's been since about 1986. This is a huge problem for Gen Z and millennials, and Gen Z in particular. Almost half of people in that age group are living with family. So that's a big, big issue as well. And that has everything to do with the lack of affordability here. Home prices just don't go down. And with rates as high as they are and home prices as high as they are and wages not really keeping pace, despite what Yellen told us, it's not really happening. This is leading us down a path where many people are locked out of the American dream of buying a home, having a family, and, that whole sort of white picket fence idea. This chart tells us that's not really a thing right now, and it may not be unless and until housing prices come down and rates come down. I feel like eventually both have to happen, and perhaps rates coming down does actually have that contrary effect of bringing housing prices down because there's going to be this huge unlock of existing supply during that period. So we'll have to see how that goes. Obviously, demand will be coming back too because more people will say, oh, lower rates. So we'll see how that works out. But I don't think this sort of plateau of where housing prices are right now is necessarily too sustainable, given that demand is essentially dead and the upward price discovery has more to do with the lack of supply because no one wants to move if they have to go get a new mortgage at like 6-7% and they have their current one at like 2.5-3.5%. So let's take a look at another area of unaffordability. That is the cumulative consumer price index from 1980 to the present. Pretty incredible. This is where we have to be a little skeptical about the idea of stable prices being a key part of the Fed's dual mandate. This doesn't look particularly stable to me. We're also lacking any natural corrective periods of deflation, not disinflation, because disinflation is just the rate of inflation slowing. Still means prices are going up. Deflation is where prices would be going down. And there has not really been any period of deflation that's lasted more than a year since 1970. That's not good, by the way. And that's one of the reasons that prices are so much higher than perhaps these top-level readings of the rate of change would suggest. And this is also the disconnect between policymakers and people like you and I that go out to the grocery store and have real-world expenses. They just look at the rate of change. We realize the cumulative impacts. And speaking of inflation, look at the price of cocoa. This is driven by concerns about what's happening with the supply of cocoa, the weather impacts that are reducing the yield of these crops. Cocoa has almost tripled in price over the last 2 years as a result, and it continues to move higher. So the price of chocolate on Valentine's Day might be a little bit more expensive this year. It's also likely to cap the margins of a lot of chocolate-centric candy companies like Hershey, who's warned about this specifically. Now let's go over to Japan. We can see the Fed's balance sheet. We can see the Bank of Japan's balance sheet. We can see they exist in completely different worlds. It's incredible. It does make you wonder, will the Fed follow this path in the long run, given how much they have to monetize the U.S. government's debt as we see larger and larger deficits and nominally higher rates? Or are we on a completely different path in Japan, who has their own significant demographic issues, a really problematic immigration policy? If you think ours is bad, look over there. And really a lack of family formation with negative population growth. So who's left to buy the government's debt, which is yielding really, really low rates comparative to the risk one might be taking? And that stimulus from the Bank of Japan certainly hasn't hurt the Nikkei, which is now approaching all-time highs. And it's been a little while. It's been almost 40 years since those all-time highs were set in the Nikkei during that real estate bubble in Japan. This is one of those cautionary tales that it can take a very long time for a bubble, after having burst, to ever reclaim those prior levels. Now, I'm not saying that Japan is in a bubble now, but back then it certainly was. And anyone who was buying into those lofty highs, it took the better part of 4 decades to get back to where you were. And that doesn't even factor for the yen, which has fallen so much since then. So if you were holding the Nikkei and you weren't hedged, you're still a very, very, very long time from real all-time highs. And emerging markets continue to see the largest inflows ever, led by China's buying. So this isn't just like people buying different emerging market ETFs and stocks. This is actually China's sovereign wealth fund and offshore accounts pouring capital in. To me, they're basically just taking money and shoveling it into a furnace, because none of the structural problems in China are being repaired here. Their real estate situation could take up to 10 years to work out, possibly longer. As we saw with Japan, it took them a long time to work those lofty highs out that were driven by their real estate bubble. And in China, real estate is about a third of the economy. It's really the most of any country in the world. And that's a big problem, particularly given that one of the ways they used to boost their economy was building empty cities, and in some extreme cases, knocking them down and building over them. That was something that happened over a decade ago as real estate was becoming an increasingly important part of Chinese economy, or the Chinese economy, I should say. Speaking of China, the one-child policy, which was abolished 8 years ago, is still having a lingering impact on the country, where the median age right now is about 38 and a half years old, but by 2050, that median age will be 50.7. This is another country where the immigration policy is not ideal, where there is a lack of family formation, where there is a poor economic outlook, so people are less likely to have kids in the present, and where there's also a lot more men than women, because during that one-child policy, families would often toss out their girls. So this is a long-term structural overhang that's a problem for this country, similar as it is a problem for Japan. And the last slide I want to share with you is Argentina's inflation forecast. This is insane. They expect to hit 257% year over year in January of 2024. So inflation is under control overall, in the US, at least at the rate of change level, and in many of the more advanced economies, and in a lot of Latin America, even like Mexico, Brazil, Chile. They've all been cutting rates, but Argentina, they're not seeing that reprieve. I know they have new leadership. Maybe they can turn the ship around, but for now, things in this country look rather perilous. So this has been this week's Charts of the Week. First time I've done it as a video. Let me know what you think. I really hope you enjoyed it. If you enjoy this type of work, check out my work at macrovisor.com. And right now we're having a 30% off sale to celebrate our 1-year anniversary. That's again, macrovisor.com. This has been Markets and Mayhem with Charts of the Week. I'll catch you next time.